February is here and it's time to share the top stocks that I personally will be buying. As someone who really focuses on the risk reward for each company, I am always looking for the best stocks so I can make smart investing decisions. So in this video, I'll be revealing my top picks for the month and why I believe they have the potential for long-term growth and success. So the first stock that I'm going to be buying in the month of February is a company called onsemi. This is a semiconductor company that, in my opinion, not only has the potential to grow substantially over the next decade, but they don't have as much risk as some of the larger companies. Now, it's important to note that just because a company is in the semiconductor industry doesn't mean that they are all in competition with one another. There are several different products that need semiconductors, and so many companies focus on specific industries. And this is going to be important when we look at a company like onsemi. Many times when we think about the top semiconductor companies, we think about Nvidia, AMD, and Taiwan Semiconductor. These companies generate most of the revenue in different industries from onsemi, who is focused on automotive and industrial. So I want to quickly break these two segments down and then talk about numbers. There are several different aspects of the automotive market. ADAS, which stands for Advanced Driver Assistance Systems, helps drivers avoid collisions while providing features like night vision, driver alertness, and cruise control that adapts depending on the situation. So for me, there is no question that this market will continue to grow, and I believe that these systems are in their early stages. Because not only are cars adding cameras, which means more potential revenue, but also this kind of technology has the ability to warn drivers when they are tired. If you want to learn more, I suggest looking at their website because they do a really good job of not only explaining what each segment does, but it really puts things into perspective for the potential growth of this sector. And speaking of growth, onsemi currently has 80% market share in the ADAS sector and 60% specifically for automotive. So when you consider how many more cars will use these kinds of products, there is no question that this could be huge for onsemi moving forward. The second aspect of their automotive sector is power. Now, there are plenty of opportunities here, from HVAC to the lighting to what is called the body control modules. There are definitely ways to continue to grow this segment, but I do think that ADAS and the third segment have a much higher potential for growth, and that would be electrification. I think it's obvious that electric vehicles are going to be the future. Now, I'm not saying that every vehicle will be electric, but over the next decade, we will definitely see a shift from ICE vehicles to electric vehicles. And this is a massive opportunity for onsemi. In fact, their silicon carbide products are in a position to not only make onsemi a leader in this space, but they've shown that these products are outstanding when it comes to performance. On November 14th, onsemi announced that their silicon carbide modules increased the efficiency of a Mercedes-Benz all-electric vehicle to complete a 700-mile trip. And when you think about electric vehicles, one of the biggest issues for people who travel is that the ranges on many of these vehicles are not as far, and it takes a while to charge them. Plus, on January 4th, onsemi announced that their silicon carbide power module for traction inverters have been selected for Hyundai Motor Group's high-performance electric vehicles. And not only do they have partners with those companies, but they are also partners with Kia and the company that everyone talks about when it comes to electric vehicles, and that is Tesla. And when you look at the valuation for this company, you'll see why I'm buying onsemi over Tesla. During their corporation's CES presentation, the company reaffirmed that they are on track to triple their silicon carbide revenue in 2023 from $300 million to $1 billion. The CEO also said that the company has $4 billion of committed revenue for their silicon carbide products over the next 3 years, which means that after this year, they would be growing at 30%. This is definitely going to be a major focus for the company moving forward, as they have also doubled their fab capacity and will double it again this year and next in order to execute on the committed revenue. Now, the downfall of this is that the company's gross margins will be impacted by 100 to 200 basis points for the next year or so. But these products, after everything settles, will actually be a tailwind when it comes to margins. And this doesn't include their other main sector, which is the industrial market. There are three aspects of the industrial market, and they are alternative energy, factory automation, and fast charging stations. When it comes to alternative energy, there is no question that energy infrastructure is going to be key to support this expanding sector. This means that onsemi's products for building solar solutions, energy storage, and power supplies are going to be incredibly important. Their factory automation is another driver of the company's growth. From robotics to power conversion to even machine vision, these products are not only essential for several companies, but there's no question this segment has tremendous expansion potential as well. And lastly, EV charging. This once again is another sector that could be growing for the next decade, because as more demand shifts from ICE vehicles to EV, we will need more EV chargers, but not just any chargers. As I said before, one of the biggest issues is the amount of time it takes to charge vehicles, and so in order to get chargers that can charge more quickly, you need high power charging stations that won't overheat. And this once again points to onsemi's silicon carbide products because of their efficiency and thermal resistance. When you think about the market share that they have with ADAS and the possibility to be a leader in silicon carbide, where they have proven to not only expand capacity, but revenues over the past year, I see this company has put themselves in a great position for the long term. Looking at onsemi's financial position, the company as of September 30th had cash and cash equivalents of almost $2.5 billion with over $850 million in receivables. They also have 3 times the number of current assets as they do current liabilities, and total assets are more than double total liabilities. So the company is in a solid financial position. Now, there are a couple of caution flags to consider. If we look at the company over the past year, their stock price did not fall like other companies. So if we see weaker numbers during their conference call on February 6th, we could see a good sized decline in the share price. But as long as it's not really bad news, I'll probably be buying anyway. The second thing is that they do have a couple of competitors, including Infineon and ST Microelectronics, but onsemi has proven to take market share in ADAS and their silicon carbide chips. Lastly, the company will be losing about $400 to $450 million in revenue in 2023 because they're exiting some of the lower margin products. So short term, this won't look good, but as I said previously, this will help their margins in the long term. Plus, the anticipated $700 million in revenue growth from the silicon carbide segment will easily cancel the losses. So even though there are potential caution flags, onsemi has done a great job to put themselves in a position to relieve those pressures. As of right now, the company is trading around $35 billion. As the company continues to grow their revenues, margins, and free cash flow, they will be able to provide more and more value to shareholders. With a free cash flow yield of about 4.5% right now going into earnings, this company is another great risk reward stock in my portfolio. I will probably continue to add this one as long as the free cash flow yield remains above 4%. To find the free cash flow yield, you take the free cash flow and divide it by the market cap. So if we see prices continue to move up or their free cash flow comes much lower than expected, then I will stop buying. But other than that, I will continue to build this one into a decent sized position. The next company that I will be buying in February is none other than Google. Now, I know the company reported okay numbers and that there is a lawsuit, which if you want me to do a video on Google's caution flags and earnings, let me know in the comments down below. But I think it's important to look at the business as a whole and what they're valued at. So for a quick overview, Google has several different businesses. They have the top 2 search engines in the world, which are Google.com and YouTube.com. The next business is their Google network, consisting of AdSense that shows ads to visitors on someone's website, and AdMob, which is similar to AdSense, but instead of websites, it's apps. And the last business is their Google Cloud. When we look at Google, they have a phenomenal balance sheet. They have about 2.5 times the current assets as they do current liabilities, and 3.3 times the total assets as they do total liabilities. They also don't have a lot of debt, and with almost $22 billion in cash, they have significantly more cash than they do long-term debt, which means they could pay it all off and still have a good amount of cash left over. Plus, with over $113 billion in cash and marketable securities, which can easily be converted into cash, they have almost twice the amount of cash as they do current liabilities and more cash than they do total liabilities. And this is not including the $40 billion in accounts receivable. So Google's financial position is one of the best in the world, if not the best. But now let's look at growth. Even though the company missed on revenue in their most recent earnings report, the biggest driver of growth is the cloud business. And Google has continued to take market share from AWS and Microsoft despite them having larger revenue numbers. Plus, I really think that YouTube over the next 5 years will not only be even larger than it is right now in terms of consumers, but YouTube is the platform most focused on supporting and monetizing content creators. Plus, they're the largest platform for social media that promotes all content. So there is no question in my mind that YouTube is not going anywhere. The biggest question when it comes to YouTube is, do you think the ads business is going to grow after we get through the recessionary environment? I think they will, and that is why I'm not worried about it. Looking at their gross margins, Google has over 50% gross margins. So the business is efficient and the company has continued to grow gross profits over the past couple of years. So what this tells us is that their revenue is outpacing the cost to make that revenue, and as they continue to grow revenues, their gross profits will grow as well. And if you know anything about Amazon's business, AWS, this cloud segment generates massive margins. And so as Google Cloud begins to generate more and more revenue, their margins will grow as well, which I think is important to consider. Lastly, when we look at profitability, the company has a free cash flow yield of almost 5%, which is still solid. But what's the company going to produce for free cash flow moving forward? A few days ago, it was announced that the company will be cutting 12,000 jobs, which was kind of expected. However, if we look deeper into the company, you will notice that in September, the CEO said that he hopes to improve efficiency by 20%. And in the previous economic downturn, Google did the exact same thing. So we can expect that free cash flow will remain the same or move to the upside. Going into 2023, Google isn't trying to expand to new products, but is really trying to focus on growing and expanding their core businesses. So this could be beneficial for Google shareholders. Now with that said, I do need to listen to Google's earnings call, so keep that in mind. When it comes to Google, like onsemi, I will continue to add as long as the company remains above a 4% free cash flow yield. So those are the companies that I will more than likely be buying in February. But now I wanted to share a couple of other stocks that I could potentially be buying as well. The first company that I'm looking to possibly add more shares is carparts.com. Carparts.com does not use brick and mortar to sell their products, but does everything online. They sell parts for car repair, maintenance, collision, and accessories for competitive prices. When we look at the industry, they do have some solid competitors like AutoZone and O'Reilly, but there's still plenty of space in the auto parts sector for these companies to thrive. And unlike their competitors who use brick and mortar, their online strategy will help in the long term when it comes to their profit margins. Plus, when you think about it, if something goes wrong with your car, you may not be able to actually drive it to the location to get the part that you need. But for carparts.com, not having physical locations allows the company to have lower expenses because they don't need to pay for as many workers or facilities. The total addressable market for carparts.com is about $300 billion, and they have less than 1% of the market share. The company generated $165 million in revenue this past quarter, and gross margins were at 34%, and said that they are continuing to focus on profitable growth. So for a company that has a market cap of $385 million and is looking to have over $650 million in revenue for the year with profitability on the horizon, there are definitely some things that I love about this company. No matter the current financial situation, cars will continue to need repairs, and I think this protects them from anything that could happen to the economy. This company has put themselves in a position where they are now able to store their products in multiple warehouses across the US and send those products to customers in a short amount of time. The company expects to send 55% of customers their parts in 1 day and 98% within 2 days. Now, one of the caution flags that I've talked about is their low amount of cash. Currently, they have almost $17 million in cash and $5 million in revolver debt. Now, they do have another $9.5 million in receivables, but this is still a lower amount of cash than what many other companies would like to have on their balance sheet. But the one thing that I'm really excited for is their do-it-for-me space. They will work with other repair shops to get the right parts sent to the best place for the lowest price. With the company basically becoming the middleman, this allows them to not need to pay a mechanic, so that means less expenses. Plus, this allows them to grow their brand awareness with the shops that they're currently working with, which I think many of us can agree that building connections is the best way to grow your brand. So I started buying this one around the $6 range, and I will continue to buy as long as it's under $8. I don't mind being patient when building my position, because if it runs up quickly, then great. I can buy some other companies, especially given the fact that the large companies have just hit their bottom. The second possible buy for me in February is Palantir. Now, I know I've talked about this company many times, so here's a quick overview. The company currently has $2.4 billion in cash with no debt and an undrawn credit commitment of $950 million. So they have a great balance sheet. The company also has over 4 times the amount of current assets as they do current liabilities, which means that they can easily pay off their liabilities over the next year. Okay, now let's talk about Palantir's growth. This is what I feel many investors are paying close attention to, because Karp, the CEO, said he believes the company will have on average 30% growth for the next few years. But we did not see that strong of growth this year. In fact, analysts have the company only doing about 23% growth, which is significantly under their projection. But despite the environment, we are still seeing Palantir form new strategic partnerships. And these partnerships aren't in the same sector either. For example, Palantir has new partnerships with Cloudflare, Tampa General Hospital, Integrity Tool and Mold, and Crisis 24, and all of these partnerships have been announced over the past couple of months. And so when I see all the partnerships that they have both in the commercial sector and the government sector, I think that they will be just fine in my opinion. They reported an adjusted gross margin of 80%. It is clear that the business is incredibly efficient, and when we look long term, the company has outstanding potential to produce greater cash flow. Now, one thing that we have seen from Palantir is that the company has continued to grow gross profit, which you take the total revenue and subtract it from the cost of revenue. So what this tells us is that their revenue is outpacing the cost to make that revenue, and as they continue to grow their revenues, their gross profits will grow as well. In the previous earnings report, Palantir shared numerous companies that have benefited from their products. With the products doing as well as they are, and Palantir has renewed deals, goes to show how sticky their products actually are. Over time, they will get more and more pricing leverage. If you're the leader in the AI software platform space and you continue to produce great results for your customers, then you will be able to charge a premium as long as your customers' businesses are thriving. And this not only could help grow revenues, but also gross margins. And this is why I'm excited for Palantir over the next couple of years. I honestly believe it is only a matter of time before more and more companies see the power of having products like Foundry. But the next few years will be telling of how well their products do for the existing customers. So lastly, let's talk about profitability. Palantir does have a low free cash flow yield of over 1%, but their margins show that they can increase their free cash flow much higher than what it is right now. It's clear that their operating loss has continued to improve quarter over quarter, but we will see how much of that will turn into free cash flow as they produce an operating income. In order for Palantir to improve earnings and free cash flow, we need to see revenue grow while their SG&A or selling general and administrative expenses remain low. Now, we may not see drastic changes in free cash flow this year, but I do think that 2024 to 2025, we will see more of a shift to free cash flow, and by that point, revenue growth will remain high. So with Palantir, even though they do have positive free cash flow, the real profitability will come later. When I think about their products and partnerships 5 years from now, I can't see the company being anywhere near the current share price. When you consider the amount of money that Palantir has on the balance sheet, no debt, and a product that the US government plus many commercial companies have seen outstanding results from, there is no question in my mind that Palantir will capitalize on any opportunities that come in the next couple of years. But I've already built out this position, so if it remains under $9, then I will continue to add. And the last company that I will be looking to buy in February is Airbnb. Now, I haven't talked about this stock on my channel before, and I'm still in the earlier phases of my research, but I wanted to share some things that I like about this company and a couple of things that I need to do more research on. So balance sheet wise, it's pretty good with about $7.5 billion in cash and cash equivalents with under $2 billion in long-term debt. The company also has almost twice the amount of current assets as they do current liabilities, so that's also nice to see. Now, their growth over the past year has been phenomenal, as analysts expect them to grow close to 40%. But one of the things that I need to look more into is how much they will grow over the next 3 to 5 years. With everything going on this year, it may not be a good representation of what we could see over the next few years. So this will be something I need to do more research on. Now, analysts do expect only 12% growth this year, which could be a cause for concern or an opportunity for Airbnb to beat much lower estimates. The last thing is that the company has strong free cash flow, which means that the company has the potential to either reward shareholders or invest that money into growth. And with the free cash flow yield over 4%, this does make me want to look deeper. Now, we have seen some issues with regulations in certain cities, so that will be something I'll be doing more research on. But I think an important thing to consider about Airbnb is that even if we saw the supply of homes fall because of city regulations, it all comes down to demand. However, this is one I've just started doing my research on and could be a potential buy after the earnings report, probably closer to the end of the month. So those are the stocks I'm looking to buy here in February. If this video provided value to you, it would mean a lot if you hit that like button. That way you can help someone else be able to see this video as well. Also, I made a video sharing my thoughts on Forbes top stocks to buy in 2023, which if you haven't seen that video, click here. Hope you all enjoyed this video and I'll see you in the next one.